Welcome to Subramani. A few days back, Gita Gopinath of IMF wrote a nice article for The Economist. Economist is not a magazine which I read which I read at all these days. I used to hog it when I was in college. And at the college library we would get it, and we thought it was great reading it, but nowadays I don't read it. I realize it's not worth reading. But Gita Gopinath has written very well, and she has said if the market were to crash, how much money would be torched. In fact, the exact sentence that she says is American stocks to the rest of the world, if they had a crash, it could torch 35 trillion of wealth. Now, you need to understand how many zeros are there after 35 to understand the impact of $35 trillion. So again, multiplied by 80 or 90, whatever, and that is the impact in rupees on the world market, right? So what she says is very sensible, in the sense that American markets are booming, and in that boom, it is just the 7 stocks, right? The top 7 stocks which are contributing to it, and she also says, I don't know why, but Europeans have put in a lot of money in the US market. Believe me, a lot of Indians have also put money in the US market. So if you have put money in the US market, or if you have put money in some mutual fund which has invested in the US market, or an ETF where you could have taken an exposure, then you should hear the rest of the story. If you're not invested in the American market, you should still hear, because she's talking of something called a concentration risk. You could also have that in your portfolio. If 30% or 40% or maybe 50% of the equity in your portfolio, which means you have an equity portfolio out of which if 35-40% is made up of one single stock or one single share, which could be your ESOP stock or something which you inherited, you should hear what I am going to say, or read. It's gone online, so it's gone viral, and so you just put Gita Gopinath. It's a very short one-pager, so you could read it. It's not a difficult read. So she says, in the flare-up of trade tensions, the market remains at an all-time high, and the surge is filled with enthusiasm around artificial intelligence. Now, if you go back in history, the automobile boom meant there were 103 companies making automobiles, out of which 3 have survived, right? And that too, General Motors, Ford, and all, Chrysler, they have all been supported by the government at various stages to see them in this form today, right? Some form they have been supported, government has supported them, right? Chrysler was supported by GM, and all those things have happened. And she is compared it to the dot-com boom, and she says, compared to the dot-com boom, where again everybody said, oh, it's now a new normal, right? Markets cannot come down, it's at a plateau from where it can't come down. Very famous statements, right? So all those things, but when the market comes down, there is a huge correction. The consequences of a crash could be far more severe and global in scope than felt a quarter of a century ago. She says a quarter of a century ago, when the dot-com bust happened, the severity of the forthcoming crash. She's not even saying when, because nobody can say when. I mean, I can be making this video in 2025 and the crash can happen in 2026 or 2027 or 2028, because by 2027 or 2028 we will start believing, no, the American equity market can't crash and Trump is doing a great job. We'll start believing everything when it is in our interest, and it is in our interest to believe that the market can't crash. So, at the heart of the concern of this exposure, both domestic and international, to American equities. So, over the past decade and a half, American households have significantly increased their holdings in the stock market. Now, if you remove, in this article, if you remove the word American and say Indian, it could mean exactly the same thing. A lot of Indian individuals, Indians are now invested in the stock market, either directly in the stock market thanks to apps, and which is a terrible trading exposure or through SIPs. And SIPs are not chosen very sensibly. It's some algorithm which is choosing. So all those who have invested through apps or those who have done DIY SIPs have no clue why they have invested in that particular, oh, this flexi cap has given the best returns, let's put all the money there, right? So that's not how the market should work, but that's what people have done. I'm not getting into whether you will lose money or gain money. Normally, if you do an SIP over 5, 7, 10 years, you are quite unlikely to lose money. At least that's what the past history shows. And the caveat, past history is not an indicator of what is going to happen in the future. So she's talking about strong American tech firms which are leading the boom, and she's saying, and now let me quote from here again, to put the potential impact in perspective, I calculate that a market correction of the same magnitude as the dot-com crash will wipe out 20 trillion in wealth for American households, which is equal to 70% of American GDP in 2024. This is several times larger than the losses during the crash of the early 2000s. The implication of consumption could be grave. Consumption is already weak, and a shock of this magnitude could cut it by 3.5 percentage points, translating to a 2 percentage point hit to overall GDP growth, before even accounting for declines in investment, right? The global fallout could be worse. The foreign investors would face a loss of about $15 trillion is what she had said, and foreign losses could be 2 trillion, roughly 4 trillion in today. Okay, she said it will be 15 trillion compared to the dot-com crash of 2 trillion, which adjusted for inflation is 4 trillion. So which means 4 times the losses of the dot-com bust which happened. So then historically rest of the world has found some cushion in the dollar's tendency during rise during such crisis or flight to safety. Now combine this with Trump's administration putting all these kind of tariffs and a lot of trade shifting to rupee, ruble, yen, real and all that, which means the dollar may not be the reserve currency. So apart from the losses that you make in the American market, what happens if the dollar falls by 10% from 90 to 82 or from 84 to 77, 76? Possible, right? So because it's no longer the reserve currency, you find China and Japan dumping treasury bonds, buying more gold. So gold prices will go up and the dollar could weaken. Could this happen? Yes, it could happen. Could it also happen that the dollar strengthens for some time, say it goes to 100 rupees to the dollar and then weaken to 70? Yes, that means a 30% fall in currency, which none of our generation have seen that happening to the dollar. We have seen, I remember 7 rupee dollar to a 70 rupee dollar to 85 rupee dollar, right? I've seen all these moves, but I've never seen the reverse. I've seen it remain steady for a long period of time, and then it again went up. But now if inflation in India is low, good chance that the dollar may not appreciate, because if the inflation in US is higher than the inflation in India, then chances are it will actually not appreciate. There are reasons to believe that this dynamic may not hold in the next crisis, because despite well-founded expectations that the American tariffs would bolster the dollar, this does not mark, so she says it may not mark the end of dollar dominance. I agree with her, nor are we ready with another currency. When the pound went, we had the dollar ready, right? So right now we don't have, and if the world tries to go back to to gold, right, to gold standards, then chances are the dollar will weaken. The nervousness is not unfounded. Perceptions of the strength and independence of American institutions, especially Fed, etc., is a little waning. Recent legal and political challenges have cast doubt on the Fed's ability. Unlike in 2000, growth faces strong headwinds whipped up by America's tariffs. So growth is not going to be too great in America and in the world. Compounding the situation and adding to the overall risk is the escalation of tariff wars. Tit for tat tariffs between America, China, maybe even India, Brazil, etc. could hurt. Meanwhile, it is important for the rest of the world to generate growth. It's not about unbalanced trade as unbalanced growth. Over the past 15 years, productivity growth and strong returns have concentrated in a few regions, primarily America, right? In other countries are able to strengthen growth that would help redress the balance, and some money could go from America back. The year's Nobel laureates in economics provide a valuable recipe for innovation led growth. So, let me just summarize by saying a market crash today is unlikely to result in the brief and relative benign economic downturn that followed the dot-com bust. And there's a lot of wealth online now and much less policy space to soften the blow of correction. So, right, so correction could be harsh and could be pretty long. So what is the implication for you if you are an investor in the US markets? If you are an investor in the US market, not having much exposure to those seven stocks, maybe you could stay there. If you have exposure to those seven stocks, shift to some other fund which does not have exposure to those seven stocks or not that much. But today it is possible only for you to redeem from American funds. You cannot invest in American funds except through ETFs. So be careful about what you are doing. It does not mean you should sell that and buy gold. Gold is also hit an all-time high. So maybe some good multi-asset fund is what makes sense. And other than that, I'm just reading out what Gita Gopinath has said. I think you should be careful. Thank you.